SIS is a market leader in all the three segments it operates in: security, facility management, and cash logistics services. Revenue and operating margins from facility management recovered for the third consecutive quarter, and we expect the momentum to continue. In Q1 FY23, revenue grew by 13% year-on-year on the back of India security and facility management businesses, while international security business remained flattish. EBITDA remained flat YOY due to labour shortages in international markets, leading to higher employee cost. Margins were under pressure on COVID-related disruptions, annual salary reviews, and incentive payouts in the India business. Net debt to EBITDA was 1.5x as on 30th of June. Now, this was higher than 1.4x in March, mainly due to higher receivable days. Gross debt has increased by 7%, primarily because of working capital requirement. India Security Solutions saw strong revenue growth and EBITDA has started to recover to pre-COVID levels. EBITDA margins improved QoQ despite annual salary reviews and incentive payouts during the quarter. Under Security Solutions, International saw revenue degrowth primarily due to the expected winding down of temporary COVID-related contracts, which was partially offset by the increase in revenue from existing customers and segments that were hit by the pandemic and its restrictions. EBITDA margins are back to pre-COVID levels. Facility Management Solutions revenue grew with major wins during the quarter coming from healthcare, education, commercial space and retail and logistics segments. Cash Logistics Solutions saw strong revenue growth with new wins in doorstep banking and cash in transit business. Focus on non-ATM businesses like doorstep banking and cash processing is yielding good results as well. SIS Australia Group has agreed to acquire 85% shareholding of Safety Direct Solutions for 5 million AUD. SDS caters to critical risk management, medical and training services and is an ideal fit and complementary to the strategic medical businesses of the SIS Group in Australia. The acquisition will make SIS Group Australia's largest emergency services provider. The acquisition is likely to be completed on or before the end of September 22. SIS has also announced meanwhile an 80 crore rupees buyback of 14.5 lakh shares at 550 rupees apiece. Now, this would be the second buyback from SIS, the previous one being in April 2021. We expect the India security and facility management businesses to be the key growth drivers, while the international security business is also likely to grow but in mid-single digits. SIS's management has maintained guidance of 20% growth in revenue, operating cash flow to EBITDA conversion of 50% and 20% return on capital employed. SIS plans to focus more on providing solutions than products and services. The future of the security business will shift more towards technology, and that's where SIS plans to invest. Given the various businesses it operates in, SIS also plans to cross-sell some of its services going forward, as some vendors prefer larger and financially more stable companies. Currently, only 1% of the revenue comes from that plan. Now, this is likely to increase. And with a likely increase in minimum wages of central and various state governments on the back of high inflation, SIS is likely to be the prime beneficiary, given that the service charges are billed to clients based on a percentage to revenues. The Australian government has announced a 4.5% increase in minimum wages. Over the next 1-2 quarters, EBITDA margins are likely to recover in Australia, given that SIS charges the same percentage as service fee, and this will now be on a higher revenue base. As the revenue grows, operating leverage is likely to kick in. EBITDA margins for the overall business is likely to recover. Of the gross debt of 1,546 crores, nearly 40% pertains to long-term debt. Now, this is likely to be paid out from free cash flows, while the remaining 60% is working capital debt, which is rolling in nature. Given the scope of higher growth rate in the India business, a majority of the services recognized under essential services, and the scope of increasing market share, we recommend investors with a longer-term view to accumulate the stock and add on declines.